night before the exam revision. Now, for those that I taught level 1 papers, MA and financial accounting, you know what this means. So this is where we cover what we expect that will come in the exam. Actually, that is an understatement. It is where we do what we are going to find in the exam. So all of us know we can't cheat in an ACCA exam, but we are going to cheat by covering the entire syllabus. Maybe the only way the examiner can outspot us is when they bring us things for financial reporting, bringing them in PM. Otherwise, if it is the PM syllabus, then we are going to cheat because we are going to cover or go through the entire syllabus. And this session is normally what makes a difference between someone getting between 45% or 40% to 50%. And I think I don't need to tell you this, that the difference between 49% and 50% is, now what is the difference? Now if you're saying the difference is 1%, the 1 mark, you're wrong. The difference between 49% and 50% is that someone who gets a 50% has passed. So in other words, they have saved their 135 pounds. But someone who gets 49%, you know what it means? You failed the exam and you have to repay the 135 pounds to resit the exam. So I know how valuable this time is, and I don't have any time to waste for you. So we start by looking at the exam. You all know that the exam is made up of 3 sections, section A, section B, and section C. Now section A has 15 questions, each having 2 marks, making a total of 30 marks. B has 3 questions, each having 5 objectives, but each objective has 2 marks, making a total of 30. Then section C has 2 questions, each question having 20 marks, making a total of 40. Total is 100, but to pass, you just need halfway, which is 50%. So now what should we expect? Now in section A, you should expect all the topics. Then section B, there are 3 questions, but this is what you should expect. The first question, the first question is expected to come from, or will come from, costing methods. So expect a question from costing methods. There are 3 questions. Expect a question from budgeting and variances, or expect a question from decision making. So these are the 3 questions. Then, so both questions, let me do this. This is budgeting, or it can be decision making, or it can be budgeting and variances. So you can get both questions from decision making, or one question from budgeting, the other one from variances. Then for your section C, what should you expect? Now for that 2 questions for 20 marks. So this is what you should expect. It is a must. You will get a question from performance measurement. So you get a question from performance measurement for 20 marks. Then the other question will be from either budgeting and control or budgeting and variances, or it can come from decision making. So this is what you'll get in the exam. So in case you get something different from this, you can alert me. The contact is here. You tell me in case you get something that is different from this. What I mean is, if you don't get a question in section C on performance measurement, if you don't get a question in section C on either budgeting and control or decision making, or if you don't get a question on costing methods in section B, you tell me. So that is why we are saying we are talking about what is going to come in the exam. Unless the examiner changes and they give you FM things, which will not happen or which can never happen. If it is PM, this is what you're going to get. Now I don't set the PM exam, but I can analyze for you and hope you get just what you need to pass a 50%. So what should you expect? Now here in section C, we've said one question will come from decision making, or it can be budgeting and control. Then here it will be performance measurement. It is a must. Then here we have 3 questions. It can be costing methods. It can be budgeting and control or decision making, budgeting and control or decision making. Now from this, what do you see? I think you can see that this is worth 20 marks. So these 2 topics are worth 20 marks. So even here, it is worth 20 marks. So you see that is already 40 in section B and C. Now what about section A? Now section A has 15 questions. Now out of the 15 questions, expect at least halfway to come from these 2 topics. In case it doesn't appear, you tell me. In case you have the time to count, so at least you get 8 questions from budgeting and control, at least. But it can be 8 to 10 questions from budgeting and control. So if they are 10, it would be this times 2, which is 20. So you see, you already have your 40 marks here, then plus 20 to make it 60. So it means from 50, 55 to 60% of the exam is going to come from budgeting and control or decision making. So you see what is left out of the 15 questions, what is left. So you can get a question, 1 or 2 questions on information systems. You can get 1 or 2 questions on costing methods, and you can get 1 or 2 questions on performance measurement. So you see, if we take the maximum, of 2 questions. This makes it 6 questions. So 6 questions will come from this, meaning whatever is left will come from budgeting and control and decision making. So the core of PM is budgeting and control. So if you don't have time, you first focus on this, then the other topics. So because this is very important, it is what we are going to start with when you're still fresh. Now, in no particular order, I'm being led to start with CVP analysis. So what is CVP analysis? It is the study of the effect of cost and volume on profit. So we are studying the effect of cost, selling price, and sales volume or units on profit. So I'll start with what you know. How do we always determine the selling price of anything? Selling price is always determined by selling price is equal to cost plus the profit. So it means selling price minus the cost, we get profit. But cost is divided into 2. Cost can be variable or it can be fixed. So this means that selling price minus, you see how I'm doing it, selling price minus variable cost minus fixed cost, we get profit. In other words, now I'm bringing in something new, but whenever we subtract selling price minus variable cost only, we get a new term called contribution. So this one means contribution minus fixed cost is always equal to profit. But if I put total, it means total contribution is total fixed cost, which is total profit. So I'm going to start from this. So how do we get total contribution? Now total contribution is given by contribution per unit times the total units So this will equal to, I'm taking this to the other side. It would be total fixed cost plus the total profit. In other words, it is simply fixed cost plus the profit. So whenever we want units, units will always be fixed cost plus profit divided by the contribution per unit. Now CVP analysis can be set for you in two different ways. It can be for a single product or it can be multiple. So we are going to have single product CVP analysis, or it can be multiple or multi-product CVP. Now the first thing is, how do we calculate break-even point? Now whether single or multiple, we are going to be doing the formulas. So when we want break-even point in terms of units, allow me to change the color of the pen. So when we want break-even in terms of units, so what is break-even? Break-even occurs when there is no profit, no loss, i.e. break-even occurs when profit is zero. So this is our general formula. This is basically what you need mostly in CVP analysis. So when we talk about break-even, it means profit is zero. So break-even would just be fixed cost divided by the contribution per unit. Then if we want break-even point in terms of sales or revenue, it would be fixed cost divided by the CS ratio. You see, if it is units, divide by contribution per unit. If it is in terms of sales, you divide by the CS ratio. Now what is CS ratio? CS ratio is simply contribution divided by the selling price. So it can be total contribution divided by total sales, or it is contribution per unit divided by selling price per unit. Both cases give you the same CS ratio. Now next we need to look at margin of safety. Now I'm not here to explain the meanings of margin of safety. So what is the formula? It is the budgeted units minus the break-even point units. So this is one way of calculating break-even. There are other two different ways, but they all come from this. So margin of safety, this is in terms of units. It can also be margin of safety in terms of sales. So if it is in terms of sales, what is changing? Instead of units, we are just putting sales. So it will be the budgeted sales revenue minus break-even point sales revenue. Then margin of safety can also be expressed as a percentage. If it is a percentage, then it will simply be the budgeted units minus break-even point in terms of units divided by the budgeted units. So if it is in sales, it will be the same thing. Budgeted sales minus break-even sales divided by the budgeted, then times 100%. Now we can move to multiple, but before we move to multiple, I want to explain to you the break-even charts. We look at break-even charts, and there are three charts. We have the break-even chart. We have the contribution break-even chart. And we have the profit volume chart. I'll look at the profit volume chart when I'm doing for you multiple products. So we are going to start by looking at these two. And to best understand these two, I'll start from what you know, the MA part. Even if you've been exempted, you know this part already. So we have two graphs. Costs are of two types. A cost can either be a fixed cost or it can be a variable cost. So to represent a fixed cost, it is something like this. So this graph here represents a fixed cost. then this graph here represents a variable cost. So when I add these two, I get a graph for semi-variable cost. So semi-variable cost would be represented as this. So this part here, in this case, this is the fixed cost, and this is the variable cost. This is fixed cost. So meaning this line here is for the total cost. So I'm going to be drawing these graphs, this same graph on both charts. So this is what we have. But be careful here. So take note of the difference between the two graphs. On the break-even chart, we are simply drawing this. So it is something like this. So initially, we first draw the fixed cost line, which is this. Then to this fixed cost, we add on the variable cost line. So from here up to here, this is fixed cost. Then from here up to here, this is variable cost. Meaning this line here is representing the total cost. Then for the contribution break-even chart, what do we do? So for this one, take note of the difference. We first draw the variable cost line. So we first draw this one first, then we draw this one. But for the first one, it was this first, then this is the second. But for this one, we first draw the variable cost line, and variable cost is drawn as a dotted line. So that is variable cost. Then to that cost, we add on the fixed cost. So when we add on the fixed cost, we get the total cost. So this line here is total cost. So from here up to here, this is variable cost. And from here up to here, this is the fixed cost. So the whole of this space here, it is fixed cost. So this is from here up to here, fixed cost. From here up to here, it is the same fixed cost. So you've seen the difference. The difference is in what do we draw first. Now, you already know this. So the only new thing is what I'm putting in the blue color. So what is new in these graphs? We just put a sales line. And sales line is drawn from the origin. It is simply like this. So this is the sales line. It is the same thing this side. This is the sales line. So we start labeling. Now what is this point here? Now this point, it is where total cost is equal to the total sales revenue. And at this point, if total cost is equal to total sales revenue, then this is our break-even point. So you see, before we break even, look at the total cost. Total cost is more than, the black line is more than the sales line, which is the blue line. So it means before this point here, we are making losses. Then after that, sales are greater than, so up here, the sales are greater than the total cost. So here, this is where we start making a profit. Now you see this is the graph. Then here I can plot for you. I can just dot here and I put this as the budgeted sales or budgeted units. Now the space between the budgeted and break-even is what we call the margin of safety. Then when we look at the other graph, the point where they are meeting is what we call the break-even point. So if these are units, then these would be break-even point units. Now before this, we are making losses. After this, we are making a profit. I've already explained that. Now why is this graph, the second one, why is it called a break-even chart? Why is it called a break-even chart? It is because you can clearly read the break-even at different activity levels. So what is contribution? You can read contribution at different activity levels. What is contribution? contribution is simply selling price or sales minus variable cost. Sales minus variable cost. So when you subtract sales minus variable cost, you get contribution. So look at the graph. Now you see the sales line is the blue line. This is the sales line. Then the variable cost is the dotted line. So let me highlight. This is the sales line and this is the variable cost line. Now I think you can see that where is the contribution. Now contribution is space here. It is the space between the sales revenue and the variable cost. So the whole of this is the contribution. The whole of that is the contribution. Now you look at this. Before this point here, what is happening? You see, now from here, now the colors are almost getting done. So from here, I'm shading the fixed cost. So from here, this point up to this point, this is fixed cost. So this part here is the fixed cost. So you see, this part here is the fixed cost. Now, so now before this point, before the break-even point, you can see that fixed cost is more than the contribution, because contribution is just this. It is the part I'm shading in yellow. So this is contribution. So before the break-even point, what I've marked as red, before this point here, what is happening? Fixed cost is more than the contribution. At break-even, so it means whenever fixed cost is more than the contribution, we are making losses. But you see, after break-even point, now fixed cost contribution is now greater than the fixed cost. So fixed cost was this space here, the whole of this in green. But after break-even point, now contribution is more than the fixed cost. That is why we are making a profit. So this graph is called break-even chart, because you can clearly read contribution break-even chart, because you can clearly read the contribution. So these are the two graphs. Now we can look at the multiple product. So for multiple products, what do we need? Number one, before you do your calculations, you need to calculate the weighted average contribution. Number two, you need to calculate the weighted average sales. Then they can ask you calculate break-even in terms of sales revenue, this or units. We are going to be using the same formulas. So for multiple products, we assume that the products are sold in a constant mix or a constant ratio. So if they ask you for break-even point in terms of units, what do? You look at this formula. It was fixed cost divided by contribution per unit. But since we are not selling one product, we are producing many products, maybe product A, product B, product C, then we can't divide by contribution per unit. We calculate by dividing by the weighted average contribution. So here we divide by weighted average contribution. And if we want break-even point in terms of sales, it is the same thing. It will be fixed cost divided by weighted average contribution out of weighted average sales. Now, how do we calculate these figures? So if you want to calculate weighted average contribution, it would be total contribution divided by the total units. It is the same thing for weighted average sales. It would be total sales divided by the total units. So what do we mean by this? But if I do for you questions, if I put for you figures, if I do calculations, we shall end up taking longer. So I want to assume you can calculate. Okay, if you can't calculate, I'm doing it very fast. We are selling 3 products, ABC. So this is the selling price. Maybe this is 10. It can be the same price. Okay, 10, then 15. I think I can make this 12. So we have variable cost, but let me just put contribution. So contribution is maybe 6, it is maybe 4, it is maybe 8. That is the contribution. So now we have the units. You might find that for A we are selling maybe 5,000 units, we are selling 10,000 units, and we are selling 15,000 units. So you see in total we are selling 30,000 units. So total here would be 30,000 units. So if we want weighted average sales, it would be total sales divided by the total units. So total sales would be sales revenue from A plus sales revenue from B plus the one from C. So it is going to be 10 times 5,000, then plus 12 times 10,000, then plus this times this. Then if it was weighted average contribution, it would be 6 times 10,000. Okay, this divided by 30, the total units. If it was contribution, it would be 6 times 5,000. So for contribution, we'll just be multiplying these. Then after you divide by the total number of units. So that is the figure you would be dividing with. So now we can look at the profit volume chart. Now rule number 1, you should know how the chart is drawn. The chart is drawn basing on the CS ratio. So step 1, you have to calculate the CS ratio. You won't be drawing the graphs, but you should know how the graph is drawn, because they can draw for you the graph, then you're supposed to do the interpretation. So we have to calculate the CS ratio because the graph is drawn according to the CS ratio. Now we work out the CS ratio for this. It would be 6 divided by 10. I'm getting 0.6. Then 4 divided by 12. I'm getting 0.33. And finally 8 divided by 15. I'm getting 0.53. So we rank the products. So which one would be the most profitable? This is first, this is second, and this is the third. So when we are drawing the graph, what do we do? So how is the graph drawn? It is a PV chart. So PV means here we have profit, or down here it is a loss. Then here we have either sales revenue or sales units. So it can be either units or it can be revenue. It is a two-way. So it depends on what the examiner has given you. Now, how is the chart drawn? Now, you need to know how profit is calculated. Profit is calculated as contribution minus fixed cost. So when we are drawing the graph, we interchange the formula and we say minus fixed cost plus contribution is equal to profit. I hope you know it is the same thing. So what do? We start with the fixed cost. So we start with the fixed cost. Now I'm assuming maybe the total fixed cost is, so if fixed cost is maybe 105, now fixed cost is incurred in total and it would be negative. So why do we have the ranking? Because we are selling products according to profitability. So when we are plotting on the graph, we actually first plot that fixed cost, which is negative 105. I'm removing the 3 zeros. So after plotting this, then, so there are two things we need to plot. It is the contribution or profit, and we need the sales revenue. So let me use the space on the side. So this is my profit, and I need the sales revenue, or it can be sales units. Now it is the question to guide you depending on what they have given you. So we first plot the fixed cost, and fixed cost is negative 105. Then we sell the most profitable product, maybe product A. So if for product A we are selling, I'm putting the units, we sell maybe 10,000 units. For B we are selling maybe 5,000 units, and for C, let me, okay, 5 and maybe 15. So I've interchanged the earlier figures. So this is the fixed cost. Then we sell the most profitable product, and what is the contribution from the most profitable product? It is simply going to be this times this. It is this times this, and if we multiply we get 60. So contribution from product A is 60. So after selling product A, what happens? If we sell product A, what actually happens next? So after selling product A, we are left with negative 45. So we've covered part of the fixed cost, we are left with 45. Then we move on to product. The next profitable is product C. So for product C, we are selling 5,000 units. Now I want to change the 5. Let me make it 10. We sell 10,000 units. So when we sell 10,000 units, we multiply, contribution would be 80. So this is contribution from product C, it is 80. So you see, after selling product C, what actually happens? We break even and we make a profit of 40. Then we can sell the next profitable product, which is product B. So we add contribution from product B. So what is the contribution from B? It is 4 times 5. That is 20. So it means our total profit would be 60. So these figures, we are going to plot them on the graph. Now sales units, if it is units, we shall be putting 10,000 units. Then we have, now this is plotted as cumulative units. So this is cumulative sales units. So on the 40, we are going to plot, we add the 10. So units of C are 10, and the total is 20. And finally for B, units were 5,000 and the total is 25. Now if it is revenue, you would have multiplied these. So what are we plotting on the graph? These are the coordinates. So we plot the cumulatives. We plot the cumulative figures. So our fixed cost was here. Now you see, after selling product C, what actually happens? After selling product A, so product A, we are selling maybe 10,000 units, and after selling the 10,000 units, we cover part of the fixed cost, and we are left with negative 45,000. So this coordinate here is the one that is representing negative 45 and the 10. Then we sell the next profitable product, which is product C. So when we sell product C, you see what happens? Cumulative units would be 20,000 units, and at that point we make a profit of 40. So 40 is maybe here. So after selling product B, so the coordinate is like here, we make a profit of 40. And finally, we sell the last product, which is product C. So for product C, 5,000 units. So it is something like this. So this is 20. It is a profit of 60. So this is now your product B. C was stopping here and F was up to that level. So I need to put them in the middle, not at the extreme ends. So if I put them in the middle, it would be something like this. This is B, this is product C, and this is product A. Now I can join this last point and the first one. It is something like that. So now take note of this. Now this graph you see here, which I'm putting in red, it is when products are sold according to profitability. Now this dotted line is when products are sold according to a constant mix. Now you see, if we sell according to profitability, we break even earlier. So break even is at this point here. However, when we sell according to a constant mix, break even is at a certain point here. So if it is profitability, we break even much faster compared to the one of the sales mix. So it is simply that. Now there are some tricky questions which have been appearing in the examiner's report, which require you to calculate. Let me call this one break even 1, and this is break even point, and this is break even C. So this BP is break even according to profitability, and this is according to constant mix. So if we want profitability, if we want break even according to constant mix, then what do? It would be fixed cost divided by the weighted average. Now it depends on what they want. If they want break even in terms of units, it would be this. If they want break even in terms of sales revenue, it will be fixed cost divided by the weighted average contribution divided by weighted average CS ratio. Sales. Now this is if products according to constant mix. Then we can also get break even point if products are sold according to profitability. Now in this case, be careful here. In this case, we need this point here. So how do we get this point I've highlighted in yellow? Now you see, we first sell product A. So when we sell product A, we reach this point here. So what do? It is the sales, either revenue or units. It depends on what the question wants. It is sales units from A, then we add on remaining fixed cost divided by, now it depends on what the question is asking. If it is in units, then we divide by the contribution per unit of the second product, and the second product is product C. Now if it was in terms of units, in terms of sales, it will be sales revenue of A, then plus remaining fixed cost divided by the CS ratio of product C, of the next product. So we need CS ratio of the next product so that we can get break even according to profitability. So the second one, it is in terms of sales, but the first one was in terms of units. So this is what you can get for contribution or CVP analysis. Now this topic has taken us much longer than expected. So now next I'm going to look at risk and uncertainty. Risk and uncertainty. So I'm going to be a bit faster here. So first we are going to look at the decision rules. Now there are 3 decision rules. Number 1, we have the max decision rule. Then we have the max mean decision rule, And finally, we have the min max regret. So under max, what do we do? Now the important thing is this, what people never tell you is how do we decide between options? How do we decide between options? So I'm putting it here on the side, and I think I should put it in red because it is very important. So it is simply this, you always decide basing on what you can control. So decision will always be based on what you can control. So for max, now it is this, whenever you see max, you call it best, and whenever you see mean, you call it worst. So for max, it is simply this. This is how you decide. It is best from the best. So you see, best from the best, it means when you're deciding, you decide in a reverse direction. So you first get the best, then from the best you pick out the best. Then next, it is the max mean. So what is max mean? It is best from the worst. So it means you first pick out the worst, then from the worst you pick out the best. But how are you deciding? You base on what you can control. Then for regret, how are we going to decide? Take note of this. For regret, so for regret, you first form a regret table. You first form a regret table. But how is the table formed? The table is formed basing on what you can't control. That is why you're regretting. You're saying, had I known, I should have maybe invested here. You base on what you can't control. Then you go to this, what I've put in red. Then you decide basing on what you can control. So I'm sorry if I put figures, we shall end up taking time on this. So we are going to stop here on this. Then next is expected values. So take note of this. Min max, max can also be called optimistic. So they can tell you if the decision maker is optimistic, which option would be selected. They are meaning calculate max. Then max mean, it means if the decision maker is pessimistic, i.e. they fear risk. So this one is for risk averse. Because they fear risk, they first look at the worst, then from the worst they pick out the best. Then next, it is the calculation of expected value, and expected value is simply the summation of probability times the outcome. Then the value of perfect information. So value of perfect information is calculated as expected value with perfect information minus expected value, but this is without perfect information. Now what is with and what is without? Now without is simply the best normal EV. It is the best outcome from the normal expected values. So maybe you have three options, option A, option B, option C. So for option A, it offers a profit of 10, B offers 12, and C offers maybe 8. So which option would you go for? It would be option B, which offers the biggest. So it is 12. Then with perfect information, it is the best EV, but this is the important part. Best EV, but it is basing on what we can't control. So you're saying, had I known that maybe the market is going to decline, I would have invested here. So that is why we are saying you base on what you can't control. So you didn't know that the market was going to decline, it was going to be static, or it was going to rain or not to rain. That is why you invested in a certain area. So if you had known, if you had gotten information, you would have picked out the best. So with perfect information, you only pick out the best, but from what you can control. Then take note if figures are costs. If figures are costs, then the best is the minimum. So decision trees, I'm not going to do decision trees. Imperfect information, I need figures to calculate for you. So also that one, I'm not going to do it for you. Decision trees, we start with a decision point. Then we have the outcomes. So I'm just imagining figures. Then how do we calculate expected value here? It is by using probability here and probability here, then there are figures. So if this is negative and this is maybe positive, you multiply this times this to get the EV here. So I think you're okay with decision trees. So risk and uncertainty can come as well in your section C, where you have to draw your own payoff table. Payoff table. So when drawing that table, the choice is yours. You can either put what you can control here. Okay, the best is to put what you can control on this side. This is what you can control, and up here you can put what you can't control. But you can interchange depending on how you will be interpreting. So you should be able to plot a decision table. Now there are different scenarios. I'm giving you an example. Maybe we are selling cakes. So selling price for a cake is $10. The cake is costing us $4, meaning the profit is, cake is costing 6, so profit is 4. So expect 3 scenarios in case this comes. Number 1, they can tell you that any cake we don't sell, any cake that is unsold cake is just thrown away. So when it is thrown away, it means we are making a loss of $6. So loss would be $6. So that is one case. We put in $6, but if it is not sold, we throw it away, we lose $6. The next case is that any cake that is unsold cake is sold at a lower price. You see, we put in $6, you find that we are selling it at maybe $2. So if we sell it at $2, then what is the loss? Let me make it 3. We sell it at $3. In this case, it means the loss is, how is loss calculated? Selling price was $3, but we put in 6, so it means the loss is $3. Now I think I should put 2. You might end up confusing. Let me just put 1. Let me put 1. Any cake that we don't sell, we sell it at $1 as animal feeds. So in this case, it means the loss would be for $5. So you see, the loss has reduced. If it is thrown away, it is 6, but here it is $5. And finally, any cake that is unsold cake, what happens is disposed at a cost. So in this case, maybe cost is, let me say $2. Now in this case, what is the impact? It means the total loss is 6, what we put in first, but we are also paying the rubbish people to throw away the cake, meaning the total loss would be $8. So that is what you need for risk and uncertainty. Now we can look at the pricing decisions. So what should we cover under pricing? The different pricing strategies, and there are 3 different pricing strategies. We have the market-based, then we have the cost-based, and finally we have the demand or opportunity cost approach, demand-based pricing. So market-based, this is basically theory. I'm picking out 2 most important or highly examined ones. We have market skimming. So you should know what it means. Skimming, you're just skimming through the market. So this one involves charging a high price when the product is first introduced into the market. So what is the aim? The aim is to make as much profit as possible in the shortest time possible. So what are the characteristics? The product has a short life cycle, so you need to make as much profit as possible before competitors go into the market with the rival product. Then next we have market penetration. So boys, this is not the it is not the other market penetration. This one involves charging low prices when the product is first introduced into the market. So what is the aim? The aim is to penetrate the market and gain a large share of the market. So what are the characteristics? I'm giving you the general one. The product has a long life cycle. So you need to look at characteristics of market skimming and market penetration. Then cost-based, it can be marginal cost. This is where we charge only variable cost. And what is variable cost? So variable cost is made up of material, labor, and variable overheads. Then it can be the full cost. So if it is full cost, it is variable plus the fixed cost. Or we can charge according to target return on investment. So here, this is where you need to calculate the return on investment. So this return on investment will be charged or will be added to the selling price. So cost-based is simply this: selling price is equal to cost plus the profit. So we base on the cost, then we add on a profit. Profit can be a markup or it can be a margin. Okay, let me look at that as well. So the problem is the profit, and we are saying profit can either be a margin or it can be a markup. So what is margin? It is when profit is expressed as a percentage of selling price, but markup is when profit is expressed as a percentage of the cost. I'm not going to explain this. We look at demand based. You should know why I'm changing the color of the pen. It is the most important. So with demand based, the question will give you, if you look at your tables, you're given a formula for price, and price is given as A minus BQ So demand based is where we charge basing on the demand, and there is an inverse relationship which is given as P is equal to A minus BQ. And in this case, when do we maximize profit? So profit is maximized when marginal revenue is equal to marginal cost. And if you look at your formula sheet, you're given marginal revenue. And what is marginal revenue? It is A minus 2BQ. So you're equating marginal revenue to marginal cost. And what is marginal cost? It is the variable cost. Now be careful, in some questions, it is you to calculate the variable cost. Variable cost might not be given, and you might, okay, let me first give you the easiest. So number one, variable cost can be calculated as it is material cost plus labor cost plus the variable overhead. Then number two, you might need to apply the MA concepts. You need to apply maybe the MA concepts. So what do we mean by this? In some questions, the figures are hidden. The variable cost is hidden. So they can tell you we are producing a product and we need 3 items. We need materials, we need labor, and we need variable overheads. So it is not a must that these 3 items are always variable costs. So if they give you 3 activities, so look at this, we produce 1,000 units, 1,200, 1,500. So I'm putting figures here. So maybe this is, let me work them out here. This is 6,000. This is 7,200. And finally, it is 9,000. Then for labor, they could give you something like this. 2,500 here. Then next, it is 2,900. And finally, the last one, it is 3,500. Then the last one, let me put, so variable overhead, I can put 3,000 here. I can put 3,600. And I can put 4,500. Now identify the variable cost. So how are you going to calculate variable cost? You need to apply MA concepts. And the first concept is if total cost is the same, then the cost is a variable cost. So it is a fixed cost. So our aim is to find variable cost. And how do we find variable cost? If cost per unit. If cost per unit is the same, then the cost is a variable cost. So we need to calculate cost per unit. And how do we calculate cost per unit? It is cost divided by units. So here when we divide 6 divided by, we get 6, we get 6, and here we get 6. So you see, it is that. It means, what does this mean? It means that material is a variable cost. If we look at the overhead, it is the same thing. If we divide throughout, it is 3, it is 3, and it is 3. But for labor, be careful. For labor, if we divide, this is 2.5. You look at labor, 2.5, 2,900 divided by 1, 2. We get 2.4. And finally, 3,500 divided by 1,500. We get 2.3. So you see, labor is a problem. So if we are looking for total variable cost, so it will be material cost, which is 6. Variable overhead is also variable because cost per unit is the same. Then plus, so in labor, you see, total cost is not the same and cost per unit is not the same. It means labor is a semi variable cost. So we need to use high-low method to find how much is fixed and how much is variable. Now if you use your high-low method, you're going to find out that, I don't want to do high-low here, you're going to find out that the variable element is $2. So total variable cost is, you add up this, and if we sum up this, we get 11. So you need to pick out how much is the variable in labor. So when you're equating, you'll be equating to 11. So it is total variable cost. You equate to 11. So this is what you should do. That is how we maximize profit. It is when marginal cost is equal to marginal revenue. So the trick is you should be able to calculate the marginal cost, and marginal cost is variable cost. The easiest would be when they give you these figures, cost per unit. Otherwise, you need to apply MA concepts to get the total variable cost. So if a cost is semi-variable, you need to pick out how much is variable so that you add up this to get the total variable cost. Then the other thing is, when do we have, so other tricks are here. I'm summarizing them again for you. When is profit maximum? Profit is maximized when marginal revenue is equal to marginal cost. Number 2, when is revenue maximum? So for maximum revenue, what do? You just equate marginal revenue, you equate it to 0. So you equate this equation A minus 2BQ and you equate it to 0. So I'm not going to go through the steps. Step 1 is to find B. Step 2 is to find A. So when we are equating, our aim is to find the quantity. Then there is a question that has appeared twice, and I can get it by drawing for you the graph. So this is the graph, this is profit, this is price, and this is quantity. So number 3 is here. They can tell you that the quantity is maximum. So when do we have maximum quantity? Look at the graph. When quantity is maximum, you see. So for maximum quantity, what happens? You equate the price to 0. So for maximum quantity, maximum quantity is when the price equation, which is A minus BQ, is equal to 0. So when you see maximum price, you equate that to 0. No, maximum quantity. Then when you see maximum price, it means quantity is 0. I'm picking this from the graph. So number 4, when you see price is maximum. So when do we have maximum price? It is here. And at that point, the quantity is 0. At that point, the quantity is 0. So if quantity is 0, you see, this happens when Q is equal to 0. And when Q is 0, it means that the price is equal to the fixed cost. So be careful with these things here I've put here. So finally, under pricing, we can look at the price elasticity of demand. Now you see, if we are calculating B, they tell you the formula that B is given as change in price divided by change in quantity. But now we are talking at paid price elasticity of demand. And price elasticity, to help you remember, just interchange the formula for B. When you interchange the formula for B, it will be change in quantity divided by the change in price. But it is not just the change, it is the percentage change in quantity divided by percentage change in the price. So how do we calculate percentage change? Look at this, year 1, year 2. So in year 1, the price of an item was $1,000, but in year 2, it is 1,200. So how do you get the percentage change in price? So to get percentage change, I hope you know this. It would be, I should have put it here on the side. So this is what we are saying. This is year 1, year 2, 1,000, 1,200. So if we want the change in price, it would be 1,200 minus 1,000 divided by 1,000 as a percentage times 100. So what have I done here? So if I want percentage change in price, it means price in the new year, I'm calling it P1, minus price in the old year divided by price in the old year. So you don't need to cram this, you apply it here. So if you want change in quantity, it would be Q1 minus Q0 divided by Q0 divided by the price in the new year divided by price in the old year divided by P0. So this is how we calculate paid. Now interpretation of paid. Look at the figures. If paid, let me give you the figures. If paid is equal to, now look at this. If percentage change is 5 and this is 5, then I have 4. Let me do 5 over 4 and I have 4 over 5. Look at these figures. So if I calculate here, the first one is 1, this is 1.25, and the last one is 0.8. This is my paid. So when paid is 1, what does it mean? When paid is equal to 1, look at the figures. It means proportionate change in quantity is equal to proportionate change in the price. So here it means the change is equal to, so Q is equal to P, but proportionate change in quantity, proportionate change in price. Then next, you look at 1.25. What does it mean? Remember up here it is quantity, but down we have price. So for the second one, we have proportionate change in quantity is greater than the proportionate change in the price. Now in this case, what do we say? We say that the product is purely elastic. So what is the meaning of elastic? It means a small change in price. When the price increases by a small amount, you're going to have a big change in quantity. That is the meaning. If price increases by a small amount, you're going to change, the quantity reduces by a big amount. Then next, when paid is less than 1. So when paid is less than 1, what does it mean? Look at the figures. It means the product is inelastic. So what makes it inelastic? It means a small change in price leads to a small change in quantity, i.e., when the price increases, the quantity reduces by a small amount. So that is the interpretation of paid. So I think we can stop here on pricing decisions. So the video is going to stop here.